Look at a typical Tuesday morning in the United States. A man wakes up in a bed he hasn't fully paid for. He turns off an alarm on an iPhone financed over 36 months. He drives to work in a car leased for $500 a month. And he buys a $5 coffee using a piece of plastic that charges him 24% interest. To the outside world, he looks like the picture of middle-class success. But on paper, he is completely owned by banks. This is not an isolated story. This is the baseline of the American economy. As of early 2026, total household debt in the United States surpassed $17.5 trillion. That is trillion with a T. To put that number into perspective, if you took all the gold ever mined in human history, you still could not pay off what the American public owes to financial institutions. Credit card balances alone have blown past the $1 trillion mark. Auto loan defaults are hitting highs not seen since the 2008 financial crash. And the average American carries personal debt that exceeds their annual take-home pay. But how did we get here? How did the wealthiest nation on earth become a country where the average citizen is living paycheck to paycheck, financing their groceries, and borrowing money just to exist? The answer is not simply that Americans are reckless spenders. It is much darker than that. The system was meticulously engineered this way. And to understand how the trap was set, we have to go back in time. Before the 1950s, debt was a source of deep social shame in America. If you wanted to buy a refrigerator, you saved your cash in a jar until you had the exact amount. Banks only lent money to businesses or the extremely wealthy. Consumer credit was considered highly risky and morally questionable. But the post-World War II economic boom changed the math. Factories that were building tanks suddenly needed to sell washing machines and televisions. And corporations realized a fundamental truth about human psychology. People will buy more things if they do not have to feel the pain of paying for them immediately. In 1950, the Diners Club introduced the first modern credit card. It was initially meant for wealthy businessmen to pay for dinners in New York City. But the concept spread like a virus. By the late 1950s, Bank of America launched the Bank Americard, which we now know today as Visa. They did something unprecedented. They mailed unsolicited credit cards to thousands of ordinary Americans. People who never asked for a loan suddenly found $50 of magical purchasing power in their mailbox. And they used it. The banks discovered something incredibly profitable. Most people would not pay the full balance at the end of the month. They would pay the minimum. And that allowed the banks to charge interest. Suddenly, the product was no longer the washing machine or the television. The product was the debt itself. But the real turning point, the moment debt became a mandatory part of American life, happened in 1989. That was the year a company called Fair Isaac Corporation introduced the FICO score. Before 1989, if you wanted a mortgage to buy a house, you sat down with a local bank manager. They looked at your job history, your character, and your savings. The FICO score removed the human element entirely. It replaced your financial identity with a 3-digit number. And it created a bizarre new rule for society. To prove you were good with money, you had to borrow money. Think about how strange this system is. If you pay for everything in cash for 10 years, you have zero debt. You live completely within your means. Your credit score will actually be terrible, because you have no track record of making banks wealthy. But if you take out 3 credit cards, finance a car, and carry a small balance, your score shoots up to 750. The system actively punishes financial independence and rewards participation in the debt machine. Once the FICO score became the standard, debt was no longer a choice. It was a requirement to participate in modern American life. Landlords started checking credit scores before renting apartments. Employers started checking them before offering jobs. Insurance companies used them to set your monthly premiums. You were forced to play the game. And the banks controlled the board. Let us look at the mathematics of how this trap works. Because it relies on financial illiteracy. Imagine you have $5,000 in credit card debt. The average interest rate in America right now hovers around 22%. If you make the minimum payment of roughly $100 a month, and you never use the card again, it will take you nearly 10 years to pay off that $5,000. And in that time, you will pay over $3,500 just in interest. You effectively bought a $5,000 couch for $8,500. This mathematical reality is highly profitable. Wall Street refers to minimum payment customers as revolvers, and they are the most lucrative demographic in the banking sector. Revolvers generate billions of dollars in pure profit every single quarter. But the financial sector did not stop with credit cards. In the last 5 years, a new psychological weapon was unleashed on the consumer. It is called buy now, pay later, or BNPL. Companies like Affirm, Klarna, and Afterpay embedded themselves into every checkout page on the internet. They removed the friction of the traditional credit check and offered seemingly harmless financing for easy payments with zero interest. It sounds like a great deal, but it exploits a well-documented flaw in the human brain. Behavioral economists call it the illusion of affordability. When a shopper sees a pair of shoes for $200, their brain triggers a pain response. But when they see those same shoes for 4 payments of $50, the brain categorizes it as a minor expense. The result was explosive. By late 2025, Americans were using buy now, pay later to purchase not just luxury goods, but basic necessities. Data shows a massive spike in consumers financing groceries, toilet paper, and utility bills through these apps. This is a massive red flag for a domestic economy. When citizens are financing a gallon of milk over 6 weeks, the middle class is effectively hollowed out. And this brings us to the most crucial piece of the puzzle: the lie of reckless spending. There is a popular narrative pushed by financial gurus. They claim Americans are broke because they buy too many lattes and spend too much on avocado toast. It is an easy story to sell, but the data tells a completely different reality. The true driver of American debt is the cost of basic survival. Let us look at the numbers over the last 40 years. Since 1980, wages for the bottom 90% of Americans have remained relatively stagnant when adjusted for inflation. Your paycheck today buys roughly the same amount of goods as it did 40 years ago. But while wages flatlined, the cost of the American dream skyrocketed. The cost of a typical home has increased by over 400%. The cost of a college education has surged by nearly 170%. And the cost of healthcare has spiraled completely out of control. In many European countries, higher education is heavily subsidized or entirely free. If you break your arm in France or the United Kingdom, you go to the hospital, you get a cast, and you go home. In the United States, a broken arm can result in a $4,000 out-of-pocket medical bill. Even if you have insurance, medical debt is entirely unique to the American experience. It is the leading cause of personal bankruptcy in the country. Nobody chooses to go into medical debt. You do not finance a heart attack because you lack self-discipline. You finance it because the alternative is dying. When you combine stagnant wages with the hyperinflation of housing, education, and healthcare, you realize something terrifying. Debt is the only bridge between what Americans earn and what it costs to simply stay alive. The middle-class lifestyle of the 1990s is now mathematically impossible to maintain on a single income. To keep up the illusion, families have replaced missing wages with credit limits, and the culture actively encourages this delusion. Social media platforms like Instagram and TikTok function as high-speed advertising engines. They present a curated reality where everyone is flying first class, driving luxury SUVs, and wearing designer clothes. This amplifies a phenomenon known as lifestyle creep. Americans feel a constant psychological pressure to project wealth, and the easiest way to project wealth is to borrow it. We buy things we do not need, with money we do not have, to impress people we do not even like. So who actually wins in this scenario? Follow the money. The winners are the massive payment processing networks. Visa and MasterCard operate essentially as a duopoly, taking a hidden tax on nearly every transaction made in the country. The winners are the mega banks, like JP Morgan Chase and Citigroup, who report record-breaking profits year after year, entirely fueled by consumer interest payments. The winners are the data brokers, who monitor your spending habits, track your credit score, and sell your financial profile to advertisers who then target you with more products to buy. The American economy is no longer based on manufacturing goods. It is a financialized economy. It runs on the securitization of consumer debt. Your car loan is bundled with thousands of other car loans, turned into a bond, and sold to pension funds on Wall Street. Your credit card debt is sliced up and traded by algorithms in Chicago. If the American public suddenly woke up tomorrow and decided to pay off all their debts and never borrow another dollar, the entire United States banking system would collapse within weeks. The system does not want you to be financially free. It needs you to be in debt. It needs you waking up every Monday morning, stressed about the mortgage, anxious about the credit card bill, and desperate enough to keep showing up to a job you dislike just to make the minimum payments. Because a population that is heavily in debt is a compliant population. They do not take risks. They do not start rival businesses. They just keep their heads down and keep paying the interest. This is the reality of the modern American dream. It is a brilliant, ruthless, and perfectly executed financial trap. And until the public understands the rules of the game, they will continue to lose. Thank you for watching. If you found this breakdown valuable, consider subscribing, and let me know in the comments below. What financial topic should we uncover next?